do it on a quarterly basis or a triannual basis. Over a period of time, what happens is the volatility eases out. As long as you know that this is a long-term investment and you have to have a time frame of at least about 5-7 years, you should be perfectly okay. If you're talking about other instruments as a part of ATC, then of course, this doesn't really matter so much. You put in the money as in how you have it.
Okay, let's go across and talk to Manoj Rajput. He's calling us from New Delhi. Manoj, welcome to the show.
Thank you very much for calling me.
You're welcome. What can we do for you?
Okay, I have a question. I'm a regular viewer of your program. Let me advise you. I'm at the age of 32 years.
Okay.
And I'm a public sector employee.
Okay.
I invest around 80,000 rupees per year in my PPF and my LIC and my PF accounts. My question is that if I want to go for the mutual funds, how beneficial it is to go for the mutual funds, because I don't need a big amount for next 3 to 10 years period. Please advise.
Okay, now when you're saying how beneficial, you're talking about in terms of returns, in terms of liquidity, or in terms of safety? In terms of return, because regarding the safety, I have other investments I have. So now the concern is regarding the returns. Right, and if you're looking at this purely from a tax saving angle, then in that 1 lakh umbrella, he has about 20,000 rupees left to invest in other instruments, if we're just talking about tax. But overall, how much do you want to put in mutual funds right now? What is your investable surplus? My idea is to invest around 40 to 50,000 apart from my investments to the mutual funds yearly. Okay. Karthik, how can we help him? Say about maybe 20,000 is what he has in that whole 1 lakh umbrella. Some money, do you think, should go into ELSS schemes?
Definitely, definitely. He doesn't need any money for the short term. He mentioned 3 to 7 years is a fairly long period of time to have, and which is correct in terms of the investment into an equity kind of an instrument. So yes, that's a good idea. Going forward, the 40 to 50,000 that he said he wanted to invest, again, you could do a mix of mutual funds. What you could do is you could look at diversified funds, you could look at mid-cap funds, and allocate a certain percentage, say about 20 to 30% to diversified, maybe another 20-30% into mid-caps, and again, if you're happy to do a little bit more aggressive funds, you could invest your remaining 10 to 20,000, which is another 40-50% of your money into such funds. In terms of returns that a mutual fund can offer you, now what happens is there's a lot of benefit there. You don't have to independently do stock research, and there are mutual fund managers and who are professionals who are doing this for you. Given a long period of time, volatility will not really adversely impact you. So it's a very good idea to stay invested for a long term. You don't have to do research yourself. Your transaction cost is lower. So net mutual fund becomes a very beautiful vehicle to go and invest into over a period of time like you want to. Okay, so since we're helping him, let's also tell him what are your top mutual fund picks right now. Which are the schemes you'd say he should put his money in today without thinking too much about it? Right, okay. Two things here. One, the fund history, about 3 to 4 years if they've run, and once we've seen some consistent performance, that's one indicator. And the second is the objective of the fund. Because we were mentioning diversified and mid-cap and aggressive, we could look at things like Templeton's Blue Chip, which is a very good fund. You could look at Templeton's Prima fund, which is another exceptionally performing fund. Reliance has a couple of schemes that are performing well. Birla's mid-cap is doing extremely well as well. So here's some kind of choices that you could have. Okay, these are some funds Ketan likes right now. We'll take a break. We'll come right back and talk some more to him and answer some of your questions. Don't go away. Welcome back. You're watching Your Money. We're talking about investment strategies today. We have Karthik Zaveri with us, who's telling you what to do with your money. And Sudhir Bailey has sent us an email from Mangalore. He has 2 lakhs in hand, kept aside to buy a house after a couple of months. He wants to know whether he can invest this amount somewhere to get benefits in the meantime. So he's looking at very short periods of investment. Where do you put your money if for just 2 months? Well, what you do is then you're essentially talking about parking funds for a very short period of time. A good idea is to get into something like a floating rate, debt fund, which protects your capital and also shields you from interest rate volatility in the very short term, because normally they adjust their interest rates on a quarterly basis. So that would also give him 0 entry and 0 exit load. So I think it's a good idea to get into some kind of a floating short-term debt mutual fund. What kind of returns is he looking at in this kind of an investment? On an annualized basis, you're looking at about anywhere from 4.5% or 5% if the fund does really well. So you just divide that by 6, and that's your return for 2 months.
Okay. What about other option? If he just parks it in a very short term, kind of a fixed deposit or even a savings account, will that make too much? Will he get a lot more from a short term debt fund?
Not really. I mean, these are more or less, similar lines. Savings would give him a slightly lesser rate of return for a very short term. Typically you get about 3.5–4% on your savings account. Fixed deposits, if you can get a 4.5 or 4.75 kind of a fixed deposit in a bank, even maybe that's an equally good option. But what happens is, with a fixed deposit, if he needs to break it prematurely, if he suddenly decides in 1 month and 15 days he wants it out, he'll have to pay some kind of a penalty for that. So then the choice remains between saving accounts and floating rate debt mutual funds, the short term floating rate mutual funds.
Okay, so those are your options if you want to park your money for 2 months. Let's go and see what Smita Bose wants to know. She sent us an email from Bangalore. She saves about 3,000 rupees per month and wants to know where she can invest it. And she's also asking if gold is a good option. Now, I would have loved to ask if she wants to buy gold for herself or for investment purposes. But right now, do you think gold is something one should invest in?
Well, I was thinking on similar lines. Why does she want to invest in gold? Because she might be able to buy about 5 or 10 grams of gold on a monthly basis. I would say gold is an asset which may or may not give you returns in line with inflation, which is one. And if she has to invest in bullion, maybe look at silver or platinum. Silver maybe for its scarcity.
Can you invest in bullion with 3,000 rupees a month?
Yeah, I mean, see, if you buy gold with 3,000 rupees a month, you're looking at about 5 grams. If you're looking at silver, then you're looking at about 250 grams or 200 to 250 grams approximately, and that much money. But it's more of a hassle, I would think, to go to the shop every month, buy it, because you don't really have with this kind of an amount, you can't do liquidated or like a demat.
So let's just assume for a minute she is not planning to buy this gold for her wedding and she wants to actually invest the money. You have 3,000 rupees a month. She's 24. Where should she put her money right now?
I think a value-based diversified mutual fund is a better idea, because I think she'll make far better returns there. And what she can do is, if she still likes gold, she could use some part of the profits over a period of time and buy the gold out of that.
SIP route for her?
Absolutely, absolutely.
Okay, thanks so much for talking to us today. Ketan Zaveri telling you where to put your money. That's it for Your Money for today, but we come back on Monday with another episode. Till then, happy investing and have a nice weekend.
Your Money, brought to you by Hitachi Atom. Very small, very powerful.
Hello and welcome to Your Money, a show that helps you make the most out of your savings and investments. I'm Vivek Loh. On the show today, we will discuss investment strategies with Karthik Zaveri, Director of Transcend Consulting, who will join us in just a bit. But first, and moving on to our today's topic of discussion, we've got investment strategies lined up for you. That's the topic we're going to talk on today. We've got Karthik Zaveri, who's a certified financial planner, as well as Director of Transcend Consulting, who's here with us in our studio. Karthik, let's get across straight to the first question of the day. We've got Vandana Nair, who's on the line. Let's speak to her. Vandana.
Hi.
Hi, good evening, Vandana. Tell us, what do you do with your money? Have you been working for a while now? Have you been investing it wisely?
See, I have just taken some mutual funds, some 2 systematic investment plans. So I don't want to invest now again in mutual funds, because I think that exposure is okay, fine.
Okay.
So what are the other avenues, if you can suggest something?
Right, but what I understand is you've only invested in mutual funds till now. Have you invested elsewhere as well?
I do have the old LIC policy and all, which is, going on from quite a while.
Okay, all right.
What are all the new dimensions we can look for?
Right. Karthik, why don't you help Vandana work out a financial plan for her quickly?
Hi Vandana. Now, since you've already invested something in mutual funds and you do have a little bit of insurance and now you're looking for alternative avenues, See, the fundamental rule is that if you want to get a fairly decent amount of return, then obviously what you need to do is straight away look at an asset class which is going to be in a condition or in a position to give you that kind of return. Now, mutual fund is a beautiful instrument. I'm going to tell you to recommend, to put your money in certain equity-linked saving schemes. I'm going to tell you to put a fair amount of money into things like pension schemes and balance schemes. So if you're not really very keen to or very comfortable in a situation where you want to have 100% money exposed, you can consider balance schemes, which will have more than 50% allocation. It will be very tax efficient also, and at the same time it will help your money grow, and that's the best long-term growth proposition that you have before you today.
Right, let's get across now. We've got Virendra Handa, who's our next caller. Let's speak to him. He's calling from Korba in Chhattisgarh. Virendra? Virendra, you'll have to switch off your TV.
Yeah,
you'll not be able to hear us otherwise.
Yeah, I'm able to hear you.
Yeah, please switch off your TV as well. Right.
Yeah, I'm able to hear you, sir.
Tell us, Virendra, what's your question today?
So my question is, I want to, after retirement, I want to invest my money, and I want a safe investment with good returns, and also health insurance.
Right. Okay. How old are you now?
I'm 58.
You're 58. Okay. And what's the kind of money you're looking at getting as a corpus when you retire?
I've written that is already there.
You've already got?
Yeah.
Okay. And how much is that?
It is written. I have about 40 lakh rupees I want to invest.
It's about 40 lakh rupees is what you've got. Okay. 40 lakh, that's his life's earnings. He obviously has to make sure he makes the most of it in the future.
Actually, yes.
How would you guide him with this 40 lakh rupees?
Mr. Handa, one of the first things that we need to do really is that once you retire, a lot of things will change. Like you said, you want to have safety of capital. At the same time, you'll also have to think about emergencies and protecting your assets so that if you run into any kind of an unforeseen contingency, you have enough money provision for that. Besides that, you also should look at steady income and the fact that your money gives you estate and that kind of benefit as well. Now, regarding healthcare, what I would say is the first and the most obvious thing to do is to get into a Mediclaim plan, and at the same time allocate about 5 to 10% of your money into some kind of a liquid or a very cash-like investment which you can use anytime. Moving on from
Give
there,
an example of that.
You could go look at any of these liquid funds that are there by these mutual funds, because the money is on call on 24 hours. You can really get it fast. At the same time, it grows at a 4-5%, and it can be very, very tax efficient as well. Okay. So moving on from there, then the next about 30 to 40%. Since you're 58, you might feel that I'm recommending 30 to 40% in equity diversified schemes, but considering that you've got another 15 to 17 years to go, it may be a fairly decent kind of an investment move to do. Moving on from there,
so about 40% should be in a diversified
30
equity
to
fund.
40%. I mean,
okay, let's take the lower end. 30% is what
yeah.
he must put in a set of diversified equity.
Precisely.
Right.
He should do that. Moving on from there, he needs to also invest a fair amount, say about 30% 25 to 35% into senior citizen bonds, which will give him 9%, which will even help him to build his estate if he wants to leave that money further for his children, etc. That 9% will be also such that because he will not have any other income, what will happen is that will generally become a tax-free income for him, as such. So that's one other thing which you could do. And the last allocation of about say another 20% I would say is to do in